of the webinar, and it's a great way to get those coaching questions in, and I'm always here to help. So we're going to start with our first page here, and again, we're talking about how fundable your business is and what does a lender see. And sometimes it's important to step back, and we talked about this last week. Step back and look at your company from a different point of view. And this week we're talking about how fundable are you? So let's go to our presentation here and we'll dive in. We talked about this page, so we're going to go here. Let's define fundable. Okay, so lenders see your business. What defines your business as fundable? It's when lenders see your business as a safe risk. You're deserving of funds and you're able to repay those funds. An actual company or individual that's authorized to borrow. These are the things that make a lender feel comfortable. So they're going to receive your application. One of the first things they do is make sure that the company and the individual is actually authorized to borrow. They look at the Secretary of State records, make sure the individual applying is able legally to do so on behalf of the business. They're going to check and make sure that the company can pay back the funds. Of course, they want to feel comfortable that they're going to get their money back and that the business deserves the funds, that they need them, that it's something that they need in order to operate their business. The lender also wants to see your business as a safe risk. So what makes a business fundable? And I believe we do. We have our finance officer on the call today, and he's going to talk with us. I'm actually going to unmute him. There we go. Dexter, are you on the phone with us?
I am, Megan. How are you today?
There he is. Very good. I'm glad you could join us. I should have introduced you at the beginning, so we're going to pause right now. Dexter Leonard is our finance officer. He is the guru when it comes to financing, and we're so excited to have him on the phone with us today because, yes, we're talking about how lenders see your business, and I think we can define him as a professional in that area. So thank you for joining us today.
My pleasure, Megan.
Yeah. Okay, so Dex is going to jump in at some point. So I'm going to go through this. And Dex, if you have anything to add, feel free to chime in. Okay?
I'll do it, Megan. Thank you.
All right. So what makes a business fundable? We're going to talk about the C's of lending. And if they come up here we go. The 5 C's of lending. So the first is the character, the capacity, the collateral, the capital, and the conditions. So let's define each of those. We're going to start with character. Who are you and your business? And the bank is going to look at that. Who is the business? Who is the business owner? What does their personal credit look like? What does the business credit look like? The corporate credibility. We talked about that last week, really putting your best foot forward and making the business look credible, having all those things in place that give somebody the perception that everything's put together and that you're trustworthy. The next one is personal and business credit history. I talked a little bit about that. They're going to look at the business credit history typically, and they also, if they can, look at the personal credit. They like to do so. It makes them feel comfortable. The personal credit reporting agencies they have a pretty refined system, and if the business owner has good personal credit, then the lender feels comfortable that the business will be run the same way. So when they do look at the personal credit, they look at the amounts that the individual has handled before, and they're looking at this on the business side too. How was the credit handled in the past? The length of history, scores, type of credit, revolving or amortized credit. So these are all factors that these bankers look at. So for instance, you all know I was a banker before I started advising, and I'd get an application, and unfortunately, I have declined a 780 personal credit score. So it's not always score. What I was looking at in those situations are these factors here, the amounts that that client has handled before. What is the highest credit limit? If the highest they've ever had is $3,000, do I feel comfortable in giving them 50? no, I haven't seen that they can handle an amount like that. So why would I want to challenge them? Remember, I'm risk adverse. I'd rather feel comfortable. So the next item is, how was the credit handled in the past? If there are lots of late payments, negatives, collections, judges, liens, those type of things, why would that individual change all of a sudden on a dime? They're probably not going to, nor is the business. And so that takes away that comfort level that I would have as a lender. The length of history. So if you've only had 1 year of history, it's not a very good sample size. Of course, a lender would feel more comfortable with a longer history of credit. It's a proven track record. The scores are a factor, the types of credit. They want to see lines, loans, credit cards, a good variety of credit on that personal credit report, because then they know that you can handle all types of credit. They also look at,
Megan,
oh, yes, Dex.
I'm so sorry. I figured I'd
No,
say something here. Yeah, and it's a great point, and I come across this quite a bit, especially for one of our main products, our UBF, our unsecured business financing. A lot of times people get to thinking that if when you see a 7 in the score, it's got to be good. And unfortunately, I've seen situations to where somebody was trying to get $20,000, $30,000 on our UBF line, our unsecured business financing, and they did have that 750 type of score, like you said before in your example. But when we got the credit report, all that was seen on there was maybe like a Capital One account for $1,100, and then a Care credit account for $700. So, it's tough for the customer to understand unless you make it make sense to them why a 750 score wouldn't be the cream of the crop. And in fact, it has to do with the body of the credit report more than the scores. So that's all.
thank you, Dex. And it's always nice to hear another voice than just mine. So I appreciate your comments and insight there. So Dex is right. They look at the meat and potatoes, not just the score. And they're trying to feel comfortable with this file. So not just the score, they're looking at the history, the types of credit, and then the last one on there is revolving versus amortized. So if I have $100,000 out in business, in personal credit cards on my personal credit report, and I've got it maxed out, well, that's high risk to a lender. They see that as high risk. Okay. And so that would mean that your revolving percentages are very high. Let's say you have a $5,000 credit card, a $10,000 credit card, and a $15,000 credit card. Um, then and I have them all maxed out except for one, does that mean my revolving percentages are still high? Yes, they look at it on a per card basis. So, if at all possible, we want our business owners to have their personal credit accounts, their revolving accounts on their personal credit about 50% or lower is the best way to go there. So keep in mind the revolving and the amortized, they like to see all different types of credit. Okay, the capacity. What is your ability to pay back the new debt? Of course, a bank wants to feel confident that they're going to get their funds back. So they're going to verify your ability to pay that back. Sometimes it's an automated system, other times it's not. So we've got here, they're going to look at employment history of the guarantor, if there is one, and not all credit has a guarantor. So this presentation talks about all different scenarios here. We're talking about the type of income they're going to use to pay it back, the stability of that income, the sources of the income, the debt to income ratio. So if I have $10,000 worth of debt and I have X amount of income coming in each day, that creates my debt to income ratio. And we want to, and I went too fast, pre we want to beware using personal debt to fund a business because it hurts your debt to income ratio. That is one of the biggest mistakes that a business that I see out of small business owners. They apply for personal credit cards because it's convenient and it's easy and you get a lot of offers in the mail, right? And so a lot of my business owners will come to me with high debt to income ratios and revolving percentages, and they need more financing, but they want it under the business because they've tapped out under the personal, and then we have a really hard time getting that funding. So the best thing you can do as a business owner is go for the business credit first and maximize your abilities on the business credit side, keeping that personal credit as clean as possible. That includes inquiries and the revolving. Okay. So let's go to collateral. Is the loan secured by collateral? And I get this question quite a bit. What is collateral? It's anything that I can take to secure a loan. So like a car loan is a collateralized loan. A loan on your home, that's a collateralized loan. We can do equipment for a business. There's lots of different things that can be defined as collateral. Banks are going to look at, is it a depreciating asset, meaning does it go down in value? Uh, and will it equally go down in value with the value of their loan? And we're looking at things from a lender standpoint. So a lot of these concepts may be foreign to you, but these are the things that lenders are thinking. So is it solvent? Can I liquidate this collateral if needed? Is it easy to file a lien? So those are the aspects that a lender is looking at when they look at a collateralized loan. And there's lots of different things that can be defined as collateral, and there's lots of different lenders that specialize in different types of collateralized loans. For instance, you may purchase a piece of equipment and be offered an equipment financing loan for that specific piece of equipment and so on. Okay. Capital. This is defined as savings, investments, and other assets that can be used to pay back a loan. So it's a backup source for repayment. At times, investments and retirement accounts may be used as collateral for financing. I know that we have some contacts with companies that will lend based on maybe a 401k or investment accounts, and so there's always some form of financing using, well, I shouldn't say always. So in general, if there is some sort of collateral, there's usually a lender out there that will lend using that collateral. Conditions. What are you going to use the money for? What is the environmental conditions in that area, the economic conditions, the industry conditions? Talking about all those things again, we're trying to think like a lender does, and these are the factors they take into account. I know when the housing market dropped, it was a lot harder to get a mortgage loan. Why? Because of the economic conditions. For instance, if you're a farmer, they're going to take into account the environmental conditions. So there's so many different aspects that these lenders are looking at, and we're trying to train our brains to think like lenders. Even though it may not feel comfortable, it's an important part of running a business. Okay. Risk and financing. Um, this is a big topic for lenders. They want to mitigate, they want to keep their risk as low as possible. So lenders are constantly identifying the risk in lending to a business. They're trying to mitigate that risk, meaning if they see risk, how comfortable are they with it? They offset the risk by reviewing the 5 C's that we just talked about. And in the end, they'll ask themselves, is this business worth the risk? Will I get my money back? Can I feel comfortable? Are they credible? And so on. And then risk determines the terms, and the terms adjust according to the risk. So this is probably an area where Dex is a professional, but the lender will look at the business and the owner and determine what the terms are: the length of the financing, the interest rate, the fees, the repayment fees, and the loan covenants, meaning is there collateral, does it have to be paid back a certain way, things like that. So if it's a riskier deal, your interest rates will likely go up. If it's a lower risk deal, the interest rates drop. And go
I'll
ahead,
add something
Dex.
to that, Megan,
Yes.
on that. This is a great example. One of our better products also is the business revenue financing. Very risky product because it's an advance. Basically, what they're doing is they're taking a customer's last 6 months of production, bringing that in, doing an average, and basically advancing, leveraging off of that and advancing money, assuming that business will continue to prosper. Now, that's a risky deal because they're not hanging their hat on anything except cash flow. Okay, so if cash flow changes, that's the risk they take. So great example here why interest rate, if you look at a business revenue deal, you may be surprised that the rates are maybe a little higher than an A type of customer, but it all correlates together from what you're saying. The risk equals the reward. So if you're going to have a riskier deal, your rates are going to be a little higher. So that's all. Great example for the business revenue.
Oh, that's perfect. I love that example. And then on the flip side of that, just because the rates are higher, because it's a riskier deal, you may not have any other financing options. Well, what am I going to do with those funds? What impact will it have on my business? And we have to sit back and look at that and say, what is the potential? What can I do with those funds? Will it have a big impact on my business? And therefore, is it worth the cost? And sometimes it is. And so,
I got an
go ahead.
example on that one, Megan, real quick. A
Uh-huh.
perfect example of a business revenue deal making sense is we had a customer that was actually selling a bottled product for another individual, and they were selling that product and making that other guy pretty rich, and they were making roughly about $7 a bottle net profit by selling his bottles. Well, he called me. He had quite a bit of revenue flowing, even though he was selling for the other guy. He decided, look, this is not a good business plan. What am I doing? Let me make myself rich. So in turn, what he did was he had the concept of bringing the bottled product in-house, tweaking it a bit to his liking, and then actually bringing production in-house, and he's actually allocating the bottles himself now. So in turn, what that did for his business, it created a cash flow over double what he was making before. Now he's going to be able to make 16 bucks a bottle by bringing it in house. So he came to me for the business revenue loan, knowing that it was a little riskier and maybe a little more expensive, but it made sense. It made sense to him that in the time to pay off the business revenue loan back to the lender, it'll take him about 5 months. In those 5 months, he would still be making $11 a bottle. So it all made sense to him. This deal worked because it doubled his income. So there's a reasoning. If somebody comes into a business revenue situation and wants quick cash to rob Peter to pay Paul, or to take care of a debt that needed to be taken care of, it just doesn't work out the same because they're not benefiting from the actual program. So definitely take under account what is the customer doing with this money. Will it make them more money?
Right.
And just like you said, Megan.
Perfect example. I love that example where it really did help that client and it helped him grow his business in a very fast way, which so that product was a fantastic fit for him. And then there's other products where if you have a fantastic personal credit score and maybe the business credit is established a bit and so on, kind of just a golden lender or client for a lender, then we can go for things where they verify that information and you can get funding pretty easily at lower interest rates and fees and so on. So there's always both ends of the spectrum, but it's important to understand that there is a direct correlation between the risk and the terms. Okay. So let's go on to our next section, improving fundability. So how can you improve fundability? That's why you're in the program. That's why we're here. And we stick to the 5 C's. And when we go through the business finance program, we are sticking to these 5 C's and we're developing them. And we're coming up with a plan to improve the business now and later. And sometimes, I talk to my business owners and they kind of are dragging their feet because they're so busy, or funds may be tight and things like that. And I look at the program, and really this process as a whole is going to the gym. We've got to do it. We've got to flex those muscles. We've got to be prepared for anything that comes up during the life of the business. So like last week we talked about being credible and putting your best foot forward. Well, this week we're talking about being fundable. And there's things that you can work on within each of those 5 C's to help your business be even more fundable. And a lot of it is just thinking like a bank and realizing, like we just talked about, the rates and the terms are a direct reflection of the risk of the deal. So understanding, what your financing blueprint is, what you can qualify for right now. Hey, these are your options in the market right now. This is what you want to do. Well, here's your options for financing. But if we do this, if we improve the personal credit, if we build the business credit reports, if we generate more revenue and so on, then we can qualify for more down the road. So understanding that process, having a plan or a blueprint is going to have a drastic effect on your business and how effective you are in making decisions. I always like to make decisions based on having a complete knowledge of as many factors as I can. And that's what we're doing, is we are walking you through how to improve the 5 C's, how to put your best foot forward and creating a plan. The next aspect of improving your fundability is submitting an application correctly to decrease errors that can lead to a decline. And it seems silly. It seems like one of the smaller items on this list, but it's one of the most important aspects. As you know, as a lender, before I started advising, and a majority of my applications were filled out incorrectly, and they typically resulted in declines. They would project their revenue, put it way above what was actual, maybe 4 or 5 million. And then I had to ask for tax returns because it seemed out of line, and then they were declined. So there's a lot of small examples like that. And so it's important to understand how to put an application in correctly. We don't want those errors. We want everything to be in line and make it as simple as possible. And so, as you know, the Business Finance Suite can walk you through this process, and that's why you are a part of the program. The advisor team can also walk you through this program, and we are your best friends in a way to walk you through this process and make it as easy as possible. Dexter, who you have heard from, is part of our financing team, and is, he is in this every day. He's applying every single day. He has constant feedback and discussions with lenders and so on. And he is a great advocate for helping a business find financing. Dex, did you have anything else you wanted to add today?
Uh, Not off the top of my head, but I just want to extend, if anybody, I'm not always available to pick up the phone, but if anybody has any questions about any type of funding program, feel free to reach out to me if I can um, provide some form of an education or maybe a flyer or detailed specifics on the program. It would be my pleasure. We're here to help you. We're working as a team to do this. So I'm all on board. So anything I can do to assist on any specific programs, feel free.
Yeah. One of the things I really enjoy about working with Dex is that he thinks outside the box, and that's what you need out of a finance officer. I mean, you could go to your lender at your bank, but they have their cookie cutter boxes. And one of the wonderful things about having a finance officer is he can step back and look at all the lending institutions and options out there and really identify what's the best fit for your need and for your business and what you can qualify for. And that's pretty amazing if you think about it. He is an asset uh, to your business because he's there to always help you with that financing blueprint, help you understand what your options are. You can see the advisor team contact information on the screen. That is our phone number and our email. So if you do have any questions about the financing, you can also reach out to us and we will get you in touch with Dexter or a member of his team. And the biggest thing is to keep in mind that we always want to step back, look at things from the lender's perspective, and understand what they want to see to make them feel comfortable to lend. And then we want to cater to what they want and put our best foot forward always. And that's our goal in the program, is to help our small business owners succeed, to really get the financing they need to help them understand what the options are. And it's a pleasure to be involved in that process and to be involved in your lives essentially as you're operating your businesses and developing them into what you've always dreamed they can be. So it's a pleasure to be part of that process. I'm so thankful everybody joined us, and especially Dexter, our finance officer. Let's see if I have any questions. We've got some good comments just saying that they appreciate the program and that it's been fantastic and so on. I don't have any questions. Hurry and submit those if you have any. But I do appreciate those positive comments. And like I said, you know, that's what makes it worthwhile for us, is really helping our small business owners succeed. Well, that's it for today's call. I will send out a recording, and please feel free to reach out to the business advisor team. We're always here to help. Have a wonderful day, everyone.